Hi everyone, Tim Knight here. I haven't done one of these video commentaries in months, and some people had mentioned that since the new blog came up, that I haven't done any video stuff. So I thought now might be as good a time as any to go through this. Um, I guess the first chart I've got on here shows what kind of market we're dealing with. There's kind of a truism that in the final stages of a push higher, all the really junky stuff that no one wanted to touch before starts to rise as well. I think Freddie Mac is about as junky as they get. It's 128% in a single day. Some others here that have gone up tremendous amounts over the recent days or months. We got our old friend DTG, which is Thrifty Rent-A-Car. Got our friends over at Avis Rent-A-Car, AIG. After having gone down from split adjusted, couple of $1,000s a share to what's this, few bucks, we've pushed up quite a bit, moving up a couple of 100% in the span of a couple of weeks. BPO, the list goes on and on. We're all well too acquainted with some of the surprising charts that we've been seeing lately. But what about the market in general? What are we really looking at? Well, my readers know that a few weeks ago, took off the bullish half suit that I was wearing. I did partake some in the lift for March through June by way of my lottery plays, and I've been pretty much a pure bear ever since then. And having gone through the charts now, I still am of that ilk. Let's look at a few charts right now that I think are representative of how fully valued I think a lot of different asset classes are. Here, for example, this is the Morgan Stanley Commodity Index. We can see here that we've got what I think is a bit of a double top in the works after having doubled over the past half year or so. So this looks pretty toppy to me. China, the China Index CZH. This too has had a big run, about 100%, and is approaching what I consider some important resistance. Looking at the mid caps here, very clean chart. We've got a Fibonacci retracement from the peak back in July 07 down to the bottom in March, and we are just about exactly that 50% line, which I've put in bold there. So you can visualize quite clearly here how far from a base to a major new bull market, which incredibly a lot of people have been talking about, we have simply clawed our way halfway back through the tumble that was experienced from mid 07 down to the first quarter of this year. So I look at a chart like this and I see people like Ken Fisher talking about a major new bull market, and I've just got to roll my eyes. And then utilities, kind of the same idea here. We've come off this Fibonacci fan and pushed up here to the underbelly of the next fan line up, plus we're beneath this pretty substantial drop as well. So a lot of resistance there. Now, there's been a lot of talk lately about inverted head and shoulders, demonstrating the potential of the markets having lots of upside left. It's sort of comic to me how when we were discussing head and shoulders back at 875 on the S&P, when it failed, a lot of people sort of clucked their tongues and said, well, naturally. But when it's in a bullish direction, people consider it quite strong and potent and ready for action. And I'm always surprised, as simple as a head and shoulders pattern is to spot, I'm always amazed at the contortions people go through to say one or another chart is either head and shoulders or inverted head and shoulders, when in fact they're nothing even close. The closest thing I found right now to an inverted head and shoulders is the Dow 30. If you look here, you can see the left shoulder, the head, the right shoulder, and somewhat of a neckline here at 9,000. This to me is still a bit of a mess because the sharpness of the drop to make that head as well as the very sloppy nature of this shoulder. I don't get real excited about this particular pattern, but let's just say that this is in fact an inverted head and shoulder. A couple of things do support that argument. One, the measured target on such a thing would be at about 11,500, way up here, which agrees nicely with the idea that we'd push up to this next fib level as well as beneath this fan line. So a rise to this area for the Dow has a certain amount of plausibility to it, I'll give you that. But looking at any of the broader indexes, the pattern really, to me, gets sloppier and sloppier. Looking at the S&P 500 here, for example, the fact that we're beneath this gigantic broken channel here is far more important than the pattern beneath it. It's also not lost on me that we seem to have paused and reversed a skosh here just beneath that line. There's no doubt that the push from the 666 up back to the quadruple digits has been fast and furious, but it also makes a certain amount of sense to me that it's exhausted at this point. I think a far more important question is what happens if we do start to fall. Do we, just plummet and cut through the March lows? I don't think so. Do we, B, pull back just a little bit and then soar much higher? Perhaps, and we've got to be prepared for that. Or do we fall some, try to ascend again and not quite get as high as before, and then start more of a in earnest kind of fall? I guess I'm putting the highest probability on that final scenario. But to me, it's entirely plausible, particularly if that inverted head and shoulders does materialize, for us to slip a little bit, maybe down to 960 or so, and then really start a firmer advance up to 1150 on the S&P and 11,500 on the Dow. That would be painful for the bears and make already exuberant bulls absolutely giddy. But the flip side, of course, is that if we did get to that area, the opportunities for the bears would be even more tremendous, I think, than they are right now. So there is a silver lining to that possible cloud. It's probably also not a surprise to anyone just how placid things have become. It seems like a million years ago that there was the possibility of a triple-digit VIX, whereas now we are at levels that we sort of tooted along with year after year after year in the mid-20s area. We're at about 25 right now. I don't know if trend lines have any import at all, but I, for the heck of it, have drawn one here, and we're just at the bottom of this fixed trend line. But we can certainly conclude from this that since last October, the amount of sort of sheer panic and pandemonium and terror has been completely eradicated, and everyone's just sort of kicked back with mojitos and isn't so worried anymore. We're at about almost 9 minutes here, so I better wrap this up. So long story short, my positions remain almost entirely bearish. I'm actually quite comfortable with that. What I am not comfortable with is what to do if we do shed 5%, 10% from here. It's very indeterminate to me what things hold after we get a bit of softness. Will that just be yet another lunge higher, or will we start to fall? As always, the only thing I can do is tighten up stops, and if indeed a resumption of the climb does happen, I'll just get boinked out of each one of them, and hopefully preserve as much profit as I can from whatever little tumble we do get. On the other hand, if we do keep falling, I'll still be in position. So that's it, and I'm on my slow laptop now, so I better start rendering this. It'll take a while, but thanks again, and I'll see you on Tuesday.